Howdy party people, it's Austin at Homeowners Financial, and this is part 2 of the credit class we're doing, which is basics, nuances, and COVID. So I'm going to do a little screen share. The goal of this, of course, is to give you the why behind, right? Because most of us don't live our lives according to the guidelines. We don't wake up and we're like, gosh, wonder if that decision would affect my loan application in the future. It's not really a thing, right? So how do we take your life? How do we pitch and position you for the best success kind of moving forward? All right. So, all right, let's do a little screen share. Let's see what's crack-a-lackin'. Okay, here we go. Rock and roll, high five. So when we talk about this, we got to talk about what is going on in your world, right? Let's talk about these basics. So of course, last time we went over the history of credit, different things from scoring, but remember, a financial plan is a roadmap that shows us exactly how the choices we make today will affect our future. So today, again, we're talking about nuances, what you really need to know for clients. Now, I originally put this together for CPAs. Last year, as you remember, was kind of a hot mess, right? And we're going to see this kind of continuing forward. So we're talking about nuances. So a nuance is, oh my God, super, super details. And the truth is, hey, let's pay attention to that. So we talk about what happens with credit when it's not necessarily being used by that primary borrower. So you co-sign on something, you're an authorized user or joint obligation. So when you co-sign, you say, hey, this person needs help qualifying to show they can pay their bills. I've got their back if they don't pay for it. We can co-sign it together just in case. Now, an authorized user is a little different. It says, normally that's like when you go to college, right? When I was 17, I wasn't legally able to have credit yet. And so my parents gave me an authorized user on their credit card. You can pay for this. You can charge things, but it doesn't necessarily mean that I was responsible for it. And then, of course, joint obligations are we're borrowing together. So who's obliged to pay for this? So technically a cosigner is obliged to pay. So if that primary person, if you cosign for your brother's car, and your brother's not paying the bills, you're supposed to be paying them. But we can exclude it from qualifying with a 12-month history that your brother has been paying for that card. Now, if your brother makes a late payment, it is going to report on your credit report. That is a big deal. They'd have to refinance you off of that or close that account in order for it to stop reporting on your history. Joint accounts, yes, we are jointly obligated. Myself and my husband are on our mortgage. We are jointly obligated. But let's say that, well, I'm not going to use an example of me and my husband not being together because that is not something I want happening. But let's see, there was a marriage and people decided to separate, and there was a 12-month history of the ex, say, paying that debt, or again, you and your brother are jointly applied because you're going to buy this house together, and then they stated it with their family. If you have a 12-month history of showing that other person has been paying it, for most loans, you can kick that out of qualification, but it is going to report on your credit report. You would have to refinance or close that in order to get out of it. Now let's talk about that authorized user. Again, this is a lot of times when people are building credit or they're too young to get credit on their own, and you're not obliged to pay that, right? You're not required to. You're just an authorized user. It's that just in case credit card that your mom got for you that's letting you use. So you can exclude it typically just from a credit supplement. The bureaus call up and say, yeah, no, it's not there. It's okay, cool. And we omit that from qualifying. And usually that authorized user can be removed without refinancing or closing. So this example where you're adding onto your parents' account, maybe as you're, stepping out in the world and you're going to college, a lot of times I'm like, oh, so you've got this Amex account with 30,000. They're like, I don't have that. I'm like, well, it was opened in 1983. And they're like, oh, that must be my parents, right? So they can get removed from it, especially if there's late payments, no offense, parents, without it being refinanced and the parents can stay on. So let's talk about business debt. A lot of clients have a side hustle or self-employed, right? There's different types of entities. So a Schedule C is that part of a personal tax return when you're self-employed and it's just you. Now, these clients, most clients just take out debt in their own name. Oh, I go get a car, it's really for the business. Now, if that we can show that that business is paying for that debt, that car, that credit card, whatever the case may be, right? We can omit that from the obligations. We have to show that it's being written off on the tax returns. So if your tax returns, again, in the instance of a car, doesn't show that you have any auto expense, then how are you writing it off and how are we showing that the business pays for it, right? Let's talk about entities, an LLC or a corporation, right? Same thing. But in loan land, this nice little regulated world that I live in, properties that are held in an LLC, a lot of times that mortgage is in the individual name. So it's going to count towards any thresholds of properties finance. And that's a big deal because different investors say, hey, if you're financing one property, we don't want to see that you have 20 properties financed. You want to be under 4, you want to be under 6 or 7 or 10, whatever that case may be, right? So it's going to count if it's in that personal individual's name. Even if the LLC is paying it, it's going to count towards that property's finance. Let's talk about a rather random nuance. So this loans and payable due in less than 1 year, this doesn't show up on a Schedule C. This really shows up on entities. This shows up on LLCs, LLPs, corporations, right? And what it is saying that this debt has to be paid off in this tax year. So let's give an example. You filed that you had $1 million of income from your corporation in 2020. It was an amazing year, but you have a debt of 1.2 million that's due by the end of 2021. Now it's great for your tax returns because it says that you don't have to pay any money on that. It's offset on your income, but it's not so good for lending anything because the same thing applies. We say it's great that you made $1 million, but 1.2 million has to go to this debt, right? It's still a thing. Your real reverence around that is car dealers. Car dealers, fun fact, operates on lines of credit from the dealership. So if you're on Ford dealership, they get cars from Ford. They're bought on a line of credit. It's a requirement. So they can write that off on their tax returns, but it's because it's revolving, because that's how that business is, it's something we can work around. So let's also take the case where, hey, yeah, I made $1 million and I showed that I owed $1 million too, but I've paid it. If we can show that that's paid or we have sufficient funds to pay it off, that's something that we might be able to work around. Again, we're in the nuances side of things, right? This isn't going to apply to everybody, but it might apply to you. Let's talk about death, divorce, and by decree. Woo, it's a little bit creepier. So death, right? The main thing to remember is that inherited property has no seasoning, right? So if my grandmother passed in last year, that was very interesting. So going back to Louisiana, doing all of this, right? She passed. She had a house in Louisiana, and through the trust, my mom inherited. So technically, it's as if my mom has owned it the entire time because it was inherited. It passed through directly, right? There's no time frame of, oh, we have to wait to use a higher value. Oh, you have to wait, take cash out of it. These are things in loans that we look at, right? But when it's a buyout, and let's say my mom had to buy out her brothers or sister, that would be a rate and term transaction. That's important because those rates are better. They're a heck of a lot cheaper, and you can go higher in loan to value. I gave some terms for a client today that wanted to take money out of their property, but they couldn't take more than 80% loan to value. They're like, we want to get all of our equity. I'm like, you can't do that. But if it was rate and term to say buy out the other co-owner, then you could. Just again, a lot of nuances, a lot of nuances. A lot of things we got to keep in mind too is there are certain situations where, let's say there's a husband and wife, and the husband got the credit, and then he passed, and the wife has been paying that bill. Well, we can show that as trustee or as the inherited that she's been paying it, but it doesn't mean that's automatically going to be extended to them. They may still have to refinance, right? So just because someone's dead and you've been paying that bill doesn't mean that that lender, mortgage or not, has to automatically grant that extension of credit to you. You probably still have to qualify for it. And then last but not least, let's talk about properties and trust. So in California, we hit probate when you hit over $150,000 in assets, not net assets, but in assets, right? Gold doubloons, Bitcoin stock, real estate, right? We're going to go through probate. So a lot of people put things in a trust. Now, creditors can still come after the new trustee or the surviving spouse. So you don't want to ignore that payment like, oh, that debt was in my husband's name, is no big deal, whatevs, right? You still want to pay attention to that because you inherited that property. They don't have to extend the debt to you, but they can look to you to pay that debt. Let's talk about divorce. Now, divorce is ticking up in this country. It has been over time, and it has a lot in this past year because people are like, that's a really small space we live in. Do I really want to be hanging out with you? So again, going to that buyout idea, right? So if you're buying out your ex-spouse, it's considered rate and term, right? We have to pay out that spouse through escrow, but that's something we do a lot of. We do a lot of divorce lending. There's so many nuances divorce lending. I'm just going to talk a little bit from the credit side of things. So one thing to keep in mind is just because you're not living with your spouse, oh, we're separated, we don't live together. But you're not unless you have a legal separation. Because in the state of California, we are a community property state. Please check with your attorney on all of this. But it doesn't mean that you can immediately just go out and buy new property. We are still a community property state unless there is a legal separation or a legal divorce decree. If it's just a pending divorce, it kind of counts like if there's a pending litigation. We can't technically lend, right? And if we're talking about, again, where maybe the husband and wife separated and the husband kept the house and he's paying that debt, we can show that he's been doing it for 12 months. Typically that while it's going to impact the wife if they're on the loan together, it's going to count from an algorithm perspective because the bureaus just run, oh, there's a late payment. But from a lending perspective, we're not going to look at that. We're going to say, hey, this debt was awarded to this guy. It is not a thing. Even if he had a foreclosure, that they were not awarded that debt, they carried it forward, they paid it on time to the time of divorce, we can kind of move forward. Let's talk about decree. Now, this is, again, like divorce. Decrees, you really think of lawsuits, right? We went to litigation because you owed me money and instead I got the property, right? So the creditor has to be formed. They have to agree to release the existing party in debt. So two business partners own a property, right? And they break up, and in the court, they go to court because it's just a hot mess, right? Is awarded to this person, and this person's not on the loan. Well, the person that to whom the debt was extended, that creditor doesn't have to automatically give it to that person, even if they've been paying it, right? But we can buy them out, right? There's no seasoning period. It was awarded to me. I get it. It's legally mine without any extra hitches or time frames. So the last thing to know is that even though that debt, let's say the property is awarded to this guy, right? And the debt was awarded to this guy, the creditor has to still approve it for them to extend credit going forward. But they're not required to report that debt and that name of that person because they weren't the original person that got it, right? And also, we're looking at bank statements. When you look at lending, we are required by the Dodd-Frank Act to show ability to repay. We look at everything. People are like, that's so dumb. Why is that a thing? I'm like, because that's the regulation, right? We have to show that there's ability to pay. So if there's bank statements that say, oh, there's a debt here, why are you paying $500 a month to X? You know, there's nannies, there's schools, right? These are things that we have to like, is this a long-term recurring debt? Is this something that we have to take in consideration that impacts their ability to pay the mortgage, right? These are things that there may be questions around. So just be prepared. And a totally random FYI, installment debt, right? So a car loan, alimony even. If there's less than 10 months at the time of closing and you have that much left over in the bank, it's something we can negate. So for example, I have a client that he's got 4 months left in his alimony. Very interesting story. Actually, the kids live with him. The ex is not allowed to be with the kids, by herself. It's a kind of a hot mess, but he had to pay her alimony. And so he's got like 4 months left. And let's just call him Bob, right? And so I'm like, hey, Bob, let's put that money aside and show that you have it. And then we can exclude that payment when you're going to qualify for a new house. So what have we learned? We've learned that there's so many nuances out there. You want to think maybe twice before you let people use your credit, co-sign with them. You want to think twice if we're just saying, I'm going to take over that payment. And certainly if we're inheriting property or we have things in degrees and drawers, let's take an extra look to see how that's going to impact you. I'm really grateful for you to take this 19 minutes with me today. Try to get as much detail as possible. Of course, if you have any questions, concerns, let me know. It's Austin at Homeowners Financial. Make it a great day.